Today, we're going to talk about the jobs report that just came out, as well as the Federal Reserve minutes that was just posted. And we're going to dissect those to give you a little bit of information on how the Federal Reserve plans to tackle the insurance front. But if you're new to the channel, welcome. This is the Rate Update with Dan Frio. I am Dan Frio, where my goal is to educate and inform you guys in everything real estate, especially the financing options that you have. So if you would, please don't forget to smack the subscribe button down below. And check out all the information we have in the description below as well to educate you guys on how to pull your credit yourselves, how to maybe shop around for insurance, and a whole bunch of other things. But other than that, let's get to it. Well, the major headlines that we have today is the Federal Reserve and what they plan on doing to basically put a halt or a lid on inflation. So during the pandemic, they actually started accumulating bonds, treasuries, corporate bonds, as well as mortgage-backed securities to keep a lid on the mortgage rates. So now they're like, okay, we got to do something to ease or start to put a fire hydrant on the flame that we've created. So they came out and said, okay, we're going to start selling off $95 billion a month of the $9 trillion a month that they hold in treasuries, corporate bonds, and mortgage-backed securities. All right, the good news is they put a cap. They said, we're going to cap our sales and we're going to wean it in over the next 3 months. Well, the good news there is we at least know that there's a lid on how much they're going to sell off, because as they push more and more bonds into the market, okay, it's going to drive down the prices because there's so much more supply, and it's going to drive up the yields. That's why you're seeing mortgage rates increase over the last several weeks because of all of this. So now we have at least some clarity in the market what the Federal Reserve plans to do. But they said they're going to gradually wean it in over the next 3 months, and then they're going to adjust things as it goes to just make sure the economy doesn't crash. Okay, so that's the one part of the news that we have right now, and I'll show you that right here. Here's my information there, and you can go to CNBC and check that out. You can also go to the Federal Reserve and actually read the minutes that they have, but I try to do this for you and just summarize it real quick. The other report that we have right now is the jobless claims. Another 166,000 people filed for new unemployment claims. Well, you might say, well, that's not good news. Well, it actually is, because this is the lowest number that we've seen since 1968. And it's also been the third consecutive week that we've had claims under 200,000. So what's this doing to the market? And that's why you're here watching. So how is all this information rolling over to the mortgage market? Well, this is what we follow. This is what we call the mortgage-backed securities market. Okay, it's a bond that trades on Wall Street that is the biggest component of your mortgage rate. Okay, so I'll explain these numbers over here for you. As this number goes up, the price of the bond's going up, thus bringing down the yields. How bonds work, there's an inverse relationship with price and yields. As the prices go up, it drives down the yield on the bond. So we love when the number's green. When the number's red and going down, the number goes down. That means the opposite. Rates are going up. And look at the chart that we've seen over the last several weeks and months. This is crazy. Okay, so again, this isn't mortgage rates, it's what's going on with the price of the bond. So as this decreases, as you see through here, and I'll get my chart out of the way, rates have been spiking, and they went from over 3% where we started the year to over 5% that where we are right now. So right now the gauge here is in the middle of the road. You can see it right through this area here. So that's, we're in a neutral zone right now with the MBS market. I'll take it, because every day recently we've seen moves down 30, 40, 70, 80 points. And that is not normal. The normal number reads usually about in this range. Okay, so I have more videos about how the MBS market works. Check out those on my channel. The next thing is, how is all this affecting mortgage rates? So here we go. How do you read this going across here? This shows you Mortgage News Daily posts this every morning and lets us know where the benchmarks are in all these areas. They talk about the 30-year fixed, 15, the 30-year FHA, government loans, which is FHA and VA, the 30-year jumbo, and adjustable rate mortgages. So let's go across this and I'll show you how this works. The 30-year rate this morning starts out at 5.08. It is up 6.06, and we call that 6 basis points. So it's up 6 basis points since yesterday. If there's a fee to get this rate, you'll see it down here. So in this case, it's going to cost you 0.4 in points to get that rate. So how you figure that out is you take the loan amount. So let's say 100,000, multiply it by 0.4, and then hit the percent sign and equal, and that will show you how much it would cost you to get that rate. Okay, so let's go across here. The 30-year fixed rate's coming in right now. It is up 6 basis points to 5.08 with a cost. Remember, guys, this isn't my rates. These are the national averages. You get the 15-year fix, it's up 4 basis points to 4.28. It is also coming in with a cost. I remember when this rate was a 30-year fixed rate just last month. The 30-year FHA/VA, this is the government section right through here, is 4.68, up 6 basis points with no points. We have the 30-year jumbo coming in at 4.4. It's up 0.10, also with no points. And we have the 5/1 ARM coming in at 4.05, up 5 basis points. And there's a big spread. There's a 1% spread right now between the 5-year ARM and the 30-year fixed. We go through here and you can see this is a historic chart of mortgage rates. It is way up there, and we just capped over the 5 range that we haven't seen for a few years now. And then the trend right now. What is the trend? Well, it's minimum to positive, meaning rates should be maybe getting a little better, if anything, but not worse. If you'd like my report, also another area down below where you can subscribe. You can subscribe to my daily newsletter as well as my weekly newsletter. It gives you all this information packed in one little email that you'll get every morning. And if you like what you see and you're like, hey, Dan, I'd really like what you do, I'd like to reach out to you guys and see how you can maybe help me with my financing on a new home, a construction loan, maybe a refinance or reverse mortgage, a debt consolidation loan, or anything else, please visit us at therateupdate.com. All my information is right there below, and you can even chat with us over here if you'd like. I'll be turning that on here shortly. So God bless, guys. Thank you so much for watching the channel. I greatly appreciate it. I'll see you later today. Bye-bye.